Welcome back, traders. Here, Chris Capri, secondsguysforex.com. So this video is about explaining how Forex pairs work. The Forex market is slightly different than, say, trading stocks. If I'm just buying Apple shares, I'm just buying Apple shares. I'm not buying it against anything else. But when you're trading currencies, the only way to make money is trading one currency against the other. I can't trade the euro against the euro and expect a profit because there's no change in value there. But when I trade, I'm trading one currency against another, and I'm expecting one to rise or fall in value relationship to the other, and that's how I make profit. So let's go ahead and explain how this works. Okay, so what it basically comes down to is you have two ways to look at this. There's really one way to look at it. You have a base currency, and you have another currency which is called the quote, or sometimes called the counter currency. Every currency for every country has a 3-letter ISO code, and that's the kind of term for ISO 4217. So, for example, the euro dollar is going to be known as EUR. That's its 3-letter code. The US dollar, USD, United States dollar. Japanese yen, JPY, Japanese yen. Australian dollar, AUD, Australian dollar. So every currency has its own 3-letter code. And so when you are trading currencies against each other, trading Forex pairs, you're going to see something like this, EUR USD. That's the euro versus the US dollar. So this is the language and structure of how we talk about currency pairs. Now, I talked about this before, base currency and quote counter currency. I'm going to give you a nice example here. So let's say the euro versus the US dollar. The euro US dollar is at 1.1425. That's the current. Let's just say that's the current price. The euro is the base currency. The second currency here is the quote or the counter currency. And the way this looks is, or translate this, is 1 euro is equivalent to 1.14. You could add the 25 in there, but 1.14 US dollars. So that when you're looking at a Forex pair or currency price, this is how you translate it. The first currency is the base currency. The second one is the quote or the counter currency. And in terms of pricing, one of the base currency is equal to this price. So that's how you translate this. Now, when we talk about pairs, there are some general terms that you're going to see a lot. You're going to hear about majors, you're going to hear about minors, you're going to hear about exotics. And so I'm going to use these next few slides to kind of explain to you what these terms mean when we talk about Forex pairs. So major pairs are any of the G10, generally it's considered that any of the G10 countries with the US, containing the US dollar. So, for example, your US dollar is considered a major because it's one of the G10 countries and it has the US dollar in it. GBP, Great British Pound to the US dollar. USD JPY, dollar yen. USD CHF, Swiss franc, dollar Swiss. USD CAD, which is a commodity currency. Aussie US dollar. Kiwi and New Zealand dollar versus the US dollar. These are majors. So when somebody talks about major, they're talking about a G10 country or a major pair. They're talking about a G10 country and a US dollar in there. And the US dollar, if you notice, can either be the counter currency or it can be the base currency. So those are any of the majors. When we talk about the minor pairs, these are currency pairs that are not containing the US dollar. So let's give some examples. And these are G10 countries, but not part of they don't have a US dollar in the currency pair. So euro to Swiss franc, euro to the Great British Pound, euro to the Japanese yen, pound to the Swiss franc, pound to the yen, pound to the Australian dollar, and so forth. Those are considered minor pairs. Real quickly before I go on to exotics, the reason why they call these major and minor is because the major currencies are ones that have the greatest transactional flow to them. They're part of the G10 countries. There's a lot more flow going through G10 countries than going through smaller non-G10 countries. So they're called majors because they not only contain the US dollar, but that's where the most transactional flow is going through. Minor pairs are going to have less transactional flow going through them, but they're still pretty poignant and have a lot of liquidity. So that's really kind of the explanation between majors and minor pairs. And then we have exotic pairs. And exotic pairs are pairs that are made up of any one major currency and one emerging market currency. So you could have the USD to the Hong Kong dollar, or the US dollar to the Singapore dollar, or the US dollar to the Swedish kroner, or Mexican peso, or Danish kroner. That can also include an exotic pair, can also include euro versus the Hong Kong dollar, euro versus the Singapore dollar, or the Swedish kroner, or the Mexican peso, or the Danish kroner. So exotic pairs are basically one major with an emerging market currency. Now, the one thing you need to understand about exotic pairs is that they are going to be less frequently traded and therefore less liquid. That means that the spreads will be larger. So you notice that the spread between the dollar and the Mexican peso is way larger than it is on the euro versus the US dollar. Because they're traded less and because there's less transactional flows going between them, they're going to have wider spreads and they're going to have less liquidity. And they can often have quite a lot of volatility. So it's important to understand the difference between majors, minors, and exotics. Okay, so we're going to explain a little bit further in terms of the spread. And this is something that's important to understand about when you're trading currency pairs. So when you're trading a currency pair or a Forex pair, you're trading one currency against the other. And there is a spread on that. And so the spread, the way to understand the spread, it's the difference between the ask and the bid price. So if you were to go into your broker platform, they generally show pricing on the chart that is either the ask or the bid. More often, it is showing the bid price. The ask price is, look, if I'm going to buy this pair, you'll see it's at 109. This is I believe it's the US dollar Japanese yen. So it's 109.407. So if I want to buy it right now, it would be 109.407 would be the price I get. If I want to sell it, that's the bid price here. That's 109.404. So you see the difference, 404 to 407? That's the spread. The spread is the difference between the bid and the ask price. And that's how your brokerage makes money. So that 0.003 difference is how your broker makes money. And they basically, what your broker is basically doing is taking prices from the interbank market. They are getting a spread themselves. So if your broker is FXCM or Saxo Bank or FX Pro or whoever it is, they are getting their liquidity from the interbank market from a liquidity provider. The liquidity provider is charging them a spread. And what the brokerage is doing is they're charging you a spread, but they're making the spread a little bit wider. So maybe their spread is 407 to 406, and they're saying, hey, I'm going to get, or maybe their spread is 406 to 405, and they're widening it a little bit. That's how brokerages make money. They make their money from the transactional spread. That's mostly how brokers make their money. So, but I'll get into more of that later when I talk about brokerages. But it's just important for you to understand that the spread is the difference between the bid and the ask price. Another term for bid and ask is buy and sell price. So as I mentioned, this is the market maker fee. The smaller the spread, the better the liquidity. And this is what we talked about with majors and minors. So if we were to look at the spread for the US dollar versus the Mexican peso, it's going to be much larger than 0.03. It's going to be much larger. So this is what you need to understand about the spread. Swap and carry. We talked about this in the last video, how you can gain additional income through carry. I'm going to explain this a little more in detail here. So the swap is the interest rate differential between two currencies. Now, we have an example here of the Swiss franc and the US dollar. Right now, the current interest rate set by the Central Bank of Switzerland is minus 0.25%. The interest rate set by the Federal Reserve in the US is 2.5%. When you do that math, that's 2.75% interest rate differential. So now we understand this. Now we understand the swap. The swap is the difference between these interest rate differentials. Now, your swap or your carry can be positive or negative. I mentioned before that you're buying one currency against the other. So if I'm expecting the Swiss franc to rise in value against the US dollar, then I'm going to buy the Swiss franc. But when I buy the Swiss franc, I'm also buying that interest rate differential. And so if I'm buying the Swiss franc and I'm selling the US dollar, then I'm paying 2.75% interest per day that I hold a position past 5 p.m. New York time. If I open my position after 5 p.m. New York time and I close it before the next 5 p.m. New York time, I don't pay any interest. But if I hold the trade past 5 p.m. New York time, I'm going to pay that interest rate differential. And so it can either be negative if I'm buying the Swiss franc, then I would be paying 2.75% interest on that transaction per day. However, if I believe the US dollar is going to gain in value versus the Swiss franc, then I would be buying the US dollar, and therefore I'm gaining the positive interest because I'm buying the currency with the higher interest rate. So every single day that I hold that trade past 5 p.m. New York, I am gaining interest rate carry or swap. So this is how you can make two incomes when trading Forex. You can make an income on the direction of the trade going in your favor, and you can make an income on the interest rate differential. So that's pretty much it for this lesson. I hope this has given you some good information about the terminology of how to look at a currency pair and understand what it means. When you see EUR USD, we're talking about the Euro US dollar, and how you understand that the first one, the first three-letter code, is the base currency, and the other one is the quote and the counter currency. So if I'm going to buy the euro versus the US dollar, then I'm buying euros and I'm selling US dollar. But if I think the US or the euro is going to go down in value versus the US, then I would be selling the euro versus the US dollar. So it's important to understand the language and the terminology here, what the codes mean, what the different terminology means, which one you're buying and selling, and also how there is an interest rate and swap if you carry your positions over the 5 p.m. New York time, and how you can use that to your advantage to make a second or additional income while trading. So that's pretty much it for this lesson. I hope you enjoyed this video, and I will see you in the next lesson.